Welcome everyone to this webinar of understanding employee stock option plan. So what are employee stock options? Employee stock options means a right given to an employee to purchase or subscribe at a future date the shares offered by the company at a predetermined price. So the company gives them the options, and once employees fulfills the conditions and criteria of ESOP plan, they are entitled to the equity of the company. Now, what are the objectives of ESOP? First and foremost, it is an important tool to attract, encourage, and retain employees, as ESOP creates sense of ownership amongst the employees. It creates wealth for the employees, and it is a win-win situation for both company and employee. And for company, it is an effective method for deferred compensation strategy, as it helps in managing the cash flow of the company. Now, what are the benefits of stock options from the company's point of view? So it is a powerful tool to attract and retain talent. It derives employee loyalty. It aligns the interest with shareholders, since employees will be the shareholders, so their interest is aligned with other shareholders of the company, like promoter group, investors, etc. It reduces the cash outflow, definitely by issuing the ESOP. Company is deferring the cash outflow and saving cash. So funds can be channelized in other prioritized areas. And yes, attrition rate is reduced with this additional reward. Employees are rewarded as their performance helps in company's growth and valuation. So now, what are the benefits of stock options from the employee point of view? Wealth creation, yes, definitely. Earlier, they are not feeling associated with the company except for the salary they are getting, plus any variable incentive linked with their performance. But when they are given the participation in the equity, so they have sense of ownership in the company, and they are creating a wealth like other promoters, shareholders, or investors in the company. They grow professionally by creating tangible value for themselves, improve job security and satisfaction. Stock monetization definitely being able to give for better results rather than regular remuneration, because regular remuneration increase in a particular manner in the company based upon the individual performance. But when the entire company grows and you have invested in the stock of your company where you are associated, and when it grows, then it will definitely give more return than the regular remuneration, and it derived direct benefits from acquisition and strategic investment. Now, which category of employee is covered under the ESOP plan? So certain employees are covered under the ESOP plan and certain employees are not covered. So employees covered are permanent employees, whether in India or abroad, full-time directors, other directors, employees, and director of the holding and subsidiary company. Employees not covered are the temporary employees, independent directors, directors holding 10% capital of the company directly or indirectly, and employees who is promoter or related to a promoter group. But yes, there is one exemption given to the startup companies in which directors holding 10% capital of the company directly or indirectly, and employee who is promoter or related to promoter group are eligible to get ESOP in case of startup company till the 10th year of its incorporation. It's a trivia question for everyone. You can write down your answers in the chat box. Who is not eligible to participate in the ESOP? Independent directors, permanent employees, or full-time directors. You can write option A, B, or C as your answers in the chat box. So correct answer is independent directors. They are not eligible to participate in the ESOP. Okay, so now brief process of ESOP. So first step is to determine the management's objective for the proposed ESOP scheme. Accordingly, the ESOP scheme will be planned, keeping in mind the decisive criteria regarding the kind of employees, the level of employees needs to be covered under the ESOP plan. After that, the company can decide the appropriate route for implementing ESOP. It can be trust route or it can be direct route. After that, ESOP scheme document will be drafted. It will get approved by the board in a board meeting. And then we need shareholders' approval in general meeting for ESOP plan. After all the approvals are done, we need to prepare the formats of all the correspondence required with the employees, grant letters, ESOP agreement, and other documents related to the ESOP plan. And valuation will also be conducted. And after that, options are granted to the employees. Options are granted, then employee accepts the offer letter within the stipulated time. And after that, vesting of the options start. So as per law, as per Companies Act 2013, there is a minimum 1 year gap between the grant and vesting. So minimum 1 year of vesting period is determined under the Companies Act 2013. In this vesting period, company can describe number of conditions, terms in the ESOP plan, such as in investing period, any employee resigns or if in his or her employment is terminated, then their options will also be lapsed and they will not get any shares. So there's a minimum 1 year of vesting period. After vesting, successful completion of vesting period, successful completion of all the terms and conditions mentioned with the ESOP plan, the options will get vested in the employees and they will get eligible to exercise those options, means to convert those options into the shares. And when they exercise the options, they will pay the share application money to the company and company will allow shares regarding against those options. And allotment is the last step in the process of ESOP. So what is the decisive criteria? Quantum, we need to decide what should be the ESOP group. Can be 10%, 5% of the capital. Pricing, the board is determine the exercise price. There is freedom given to board to determine the exercise price at the time of grant of options. Vesting period, yes, there's a minimum period of 1 year, but it can be 2 years, 3 years, as per the requirement of the company. It can be time-based or performance-based. It can be standard across the board, or it can be different for different category of employees. Grants can be yearly, half-yearly, quarterly. There can be a different policy for new joinees, eligibility and effective date of grant, promotions, group company transfers, policy regarding the termination or retirement of the employee, liquidity to employees. Yes, it is a very important aspect of the ESOP plan where the company needs to mention how the employee will get liquidity of those shares. And shares are allotted to the employees, now how employee will liquidate those shares to get the cash. So the methods could be ESOP buyback. It could be transfer of shares from employees to the investors, or the company can provide exit to employee through IPO route. There is a very frequently asked question that what is the difference between ESOP and sweat equity? So ESOP shares are issued at the option of the employees, and sweat equity shares are issued directly for providing know-how or idea to the company. Eligibility is, like I said earlier, permanent employees, director, full-time director, directors and employees of holding subsidiary company, excluding independent director, director holding more than 10% of the capital directly or indirectly, and promoter or a personal capital. Assumption can be starting for sweat equity, permanent employees, directors, full-time directors, directors and employees, and it includes independent director, as such, as it is. Consideration, so yes, cash consideration should be paid by the employee as an exercise price. For sweat equity, shares can be issued with or without consideration. Locking period, there is no specified as such, but yes, there is a vesting period of time so, but there is sweat equity, there is a minimum 3 years. Employee director cannot sell his or her share before completion of 3 years. Pricing guidelines is not specified in the price needs to be defined by the registered vendor. Quantum of shares, no such restrictions, but in sweat equity, in 1 year, 15% of their capital or share value of 5% is higher, and any given point of time, not more than 25%. Minimum vesting period, yes, 1 year. There is a vesting period, there is locking period of 3 years. So there is one trivia question. You can write down your answers in the chat box. Company wants to issue ESOPs to the spouse of the company. The spouse is actively working in the company as a head of the company. Can the employee issue ESOPs? Yes. Yes, you can have a registered startup. C, write down A as your unnecessary charges. The correct answer is yes. Stocks can be reported with the motor group if the company is registered under the registered startup with DPN.
Okay, so let's now move on to the valuation. In valuation of ESOP, whenever this topic comes, there are mainly two types of valuation that are required in this. One is for the accounting purpose, for recognizing the compensation cost in the books of the company. And the second is for the perquisite value to be calculated in the hands of the employee. So valuation, the value of stock option is needed upon grant during interim periods and at the final payment date to facilitate the calculation of the benefit to the employees. Now, in accounting valuation, it is mostly required at the grant date and at each reporting date or at the modification of the terms of the policy. Say if during the term of the policy we modify, say, the exercise period or exercise price or any of the key terms of the policy, then we need to do the valuation again at that modification date. At each reporting date depends on the type of ESOP. So if it is basically if you are doing intrinsic value method that we will come to next, then it will be done at each reporting date. Or if we are doing the fair value method, then it is at the grant date and modification date. And perquisite valuation is done at the time of when the ESOP is exercised by the employee and shares are being allotted to the employee. At that time, for calculating the perquisite tax, this valuation is required. Now, secondly, whenever we talk of ESOP valuation, now there are two things involved. One is valuation of shares and the other is valuation of the option. Many times when we talk of ESOP valuation, there may be cases where only valuation of shares is required. The option valuation as such is not required. Like in the case of perquisite. In that, when we are calculating the perquisite, at that time, we are only doing the valuation of the shares of the company and not of the option as such. So, and this valuation of shares is mainly required in the case of unlisted companies or private limited companies, which are not listed on any stock exchange. So we don't have any quoted market price for that. If it is a listed company, we already have the quoted prices. We can use those prices. Similarly, in case of capital gain, when the employee is going to sell that share to some other shareholder, at that time also the valuation of shares is required, not the option message. And then for valuing the option also, we require the valuation of shares. So these are the three scenarios where valuation of shares is required. Now, when valuation of option is required, this is required at the time of the grant of the option and at each reporting date and at the modification of the terms as we discussed earlier. Okay, now let's see the methods in this. So there are two main things. First is the intrinsic value method, and the second is the fair value or method or the option pricing methods. Now, in intrinsic value method, it is basically the difference between the option strike price, exercise price, and the fair value of the shares. So if say your fair value is say ₹100 and your option value is sorry, exercise price of the option is 70 rupees, then the intrinsic value of the option is 30 rupees. That is a very simple calculation in the intrinsic value method. Whereas in option pricing methods, we use various methods like binomial method, Black-Scholes or Monte Carlo to arrive at the fair value of the option. So in fair value, we would use some volatility adjustment, some probability metrics of future, some discounting factor. All those things are considered. Whereas in intrinsic value, nothing is of those is considered. Here, one difference I would like to highlight is in case of Indian GAAP, where there is a small companies and they are not required to follow the Ind AS, which are based on IFRS. The Indian GAAP allows companies to follow either intrinsic method or the fair value method, option pricing methods. Whereas if you are adopting the IFRS India S, then fair value method is mandatory. Then you cannot take the intrinsic value method. Okay, so let's understand these methods, option pricing methods. Binomial method is the most popular amongst the lattice-based models, which is like discrete time series-based models. In this, we trace the underlying variables of the option over discrete time nodes, like 1 month, 3 months, 6 months, like that. We trace the variables and then arrive at the outcome. At each node, the possible price of the underlying asset is mapped either upwards or downwards in multiple of a certain factor. And based on that, a binomial tree is created. So basically, we would assume, say, right now the price is 100. Price of the share is 100. Assuming that there is a 10% volatility in the stock, after, say, 1 year, the price will go up to either 110 or come down to 90. Then after that 110, another 1 year period, so 2 years from now, the price might go again 10% up or 10% down. So that 110 will become either 121 or 99. Like that, we take calculate the nodes for each time interval and calculate the option value at each time interval and then discount it back to the current period using the again probability for each node and time period. So this binomial method is useful in this ESOPs because it takes into account early maturity. So let's move on to the Black-Scholes model. So while binomial model assumes discrete time intervals like 1 month, 2 months, 3 months, 4 months, 6 months, Black-Scholes assumes a continuous period. Like what happens actually, the share value is continuously changing over the period of time. Every minute, every hour, every day, it is changing. So it takes into consideration the continuous period and compounds accordingly over a normal distribution of various variables. This determines the price of an option by calculating the return an investor gets less the amount that investor has to pay. Investor has to pay the exercise price using the log normal distribution probabilities to account for volatility in the underlying asset. So while the formula might look quite complicated for this, the basic concept is again that it takes into account the volatility of the share price, and then based on that, it assumes that what will be the price at the end of the period, end of the maturity of the option, and what is the strike price, exercise price, and difference between those things, price, and then discount it back to the current date. That is the basic concept of but it is only taking into account the end of the option period value. It is not taking values in between, say, the whole life of the option is say 3 years, but so it will take the value only at the end of 3 years. It will not take the value at 1 year, 6 months, or 2 years. Whereas in binomial, we can do that. We can take the value at various intervals as well. And in Monte Carlo, it is basically a simulation-based method, a computational algorithm that uses repeated random samplings to estimate probability outcome. So in this, basically, we can create scenarios, 1,000 scenarios, 10,000 scenarios, and then arrive at the value of the option. Now, there are some limitations as I highlighted in between. In a binomial model, binomial distribution on multiple time periods rather than change over continuous distribution. So as I mentioned, it is discrete at either 1 month, 3 months, 6 months, but not a continuous process. While trading is not a discrete thing, it happens continuously. In Black-Scholes, the volatility, so it assumes same volatility over the life of the option. That is one thing. then it assumes a constant risk-free rate during the time of the maturity, while it could vary actually. Then again, there is always an assumption of zero arbitrage, 100% market efficiency. So some limitations are there in this as well. And early exercise is not an option in the Black-Scholes. So these are the main variables, main elements which are used in both the binomial and Black-Scholes model. First is the exercise price, life of the option, current price of the underlying shares, expected volatility of the share price, dividends, and the risk period. Let's discuss them. So exercise price is the price at which the employee has the right to buy the shares from the company. The life of the option. Now, this is very important in the valuation. This is the total period from the grant date of the option till the exercise of the option. Now, this period will have the vesting period as well, where the employee is not yet eligible to exercise. And then there is an exercise period as well, where the employee is eligible to exercise. Now, there can be cases where an employee has, say, 1 year of vesting period and 2 years of exercise period. So if the option is granted today, after 1 year, the employee can exercise, but it can only exercise up to 3 years. Basically, it's not necessary that the employee will exercise immediately after 1 year. It can exercise after 1.5 year, 2 year, 2.5 year, but only up to 3 years. It cannot exercise beyond 3 years. If they don't exercise up to 3 years, the option will lapse. Now, so that creates those scenarios of early exercise, while the total life might be up to 3 years, but we in that case we have to assume what would be the likely scenario of the option being exercised. Now, these likely scenarios can depend again on multiple factors, like the transferability of the stock option. If the stock option is transferable, they may be able to exercise early, or then if the price of the underlying shares. So if the price of the underlying shares is high and exercise price is low, that is the option is already in the money, then the employee is likely to exercise it early and take the cash benefit. Otherwise, if it is not in the money, they may not exercise immediately. They will wait for the price to go up and then only exercise. Like similarly, senior employees might have more visibility on the company outlook, so they may see if the company is expected to do better in coming years. They will exercise it at a later date, while the junior employees may want to encash early. So these are basically the trends that have been noticed over the past transactions. Again, based on the volatility of shares, if volatility is high, it is again there is likelihood of early exercise, whereas if volatility is low, then it can be later exercise. Historical trend of the similar options or the lock-in period. So longer the life of the option, the lower will be the value of the option, because that discount period increases. Then the current price, current price is again the fair value of the shares of the company. So higher the current price, higher will be the value of the option. Again, expected volatility, higher the volatility, lower will be the value of the option. It is like the volatility is the standard deviation of the stock's annualized returns over the given period and shows the range in which its price may increase or decrease. So basically, if we talk about listed companies, it is the movement in the price of the listed company share price over the period. So this period should match with the life of the option. So if the life is 3 years, we should observe the volatility also over the 3-year period on an annualized basis. So again, for unlisted companies, the volatility is observed based on comparable listed companies, because the data for their own shares is not available, so we can use the data for the comparable listed companies. Dividends, if the company is giving dividends, that reduces the value of holding of the stock. So again, the value of option also goes down. And risk-free rate is basically the rate that is used for discounting of the options in both the methods. So risk-free rate, again, the time period for which we are using the risk-free rate should match with the life of the option. So if the life is 3 years, then the time period we should use is 3 years. We should use rate for the government bond closer to the 3-year maturity period. Okay, so now there's a trivia question. An Indian company with a turnover of 50 crore wants to implement ESOPs. Their company has not adopted Ind AS for its accounting. What method will it use to account for its employee compensation? You can write your answers. Okay, let's see the answer then. It is C. So Indian GAAP gives you the option, the choice. You can adopt either intrinsic value or option pricing. It's not mandatory. Either of them is not mandatory. Okay, so there were quite a few queries on the difference between employee stock option, RSUs, and stock appreciation rights. So we have covered this as a topic. So in ESOPs, we issue the stock options initially, which gives employees the right to buy the shares, but they may or may not buy. Whereas in RSU, we are issuing shares directly. We are not giving them any option. We are directly issuing them shares once they meet the conditions. And in stock appreciation right, nothing is issued. We are only giving them right to participate in the appreciation of the share price, but we are not issuing them any shares or options. So in that case, there is no dilution in for the company, while in the other two cases, they are dilutive for the company. Then statutory coverage, while ESOP, for ESOP, there are elaborate guidelines both in the Companies Act, SEBI regulations, and Ind AS. But for RSUs, it is not specifically covered in Companies Act. So the Companies Act and Ind AS, but it is covered indirectly in SEBI regulation. Similarly, for stock appreciation rights, again, there is no specific coverage in Companies Act, but it is covered in the Ind AS and SEBI regulations. So, then ESOPs are equity settled. So that means the company has to issue equity to settle them, whereas RSU can be either equity settled or cash settled. In stock appreciation rights, it is always cash settled. No equity is being issued. Then in ESOPs, employee is making the payment to the company, paying the exercise price to receive the shares. Whereas in RSU and SARs, again, no payment is being made by the employee. Then in ESOPs, again, they become as a regular shareholder once they exercise the options and purchase the shares. So they become a regular shareholder. But in RSU, it is a restricted share, so no voting right or dividend is given. Dividend right is given. And in SARs, as no security is issued, no voting and dividend again. Taxation perspective, it is perquisite for employee. In ESOP case, the perquisite will be difference of fair market value and exercise price. Whereas in RSU, since there is no exercise, no payment is being made by employee, the whole fair market value will be the perquisite value. And in case of SAR, again, the difference between the fair market value and the base price that is being set. And capital gain will be the sale price less the fair market value for ESOP and RSU.